Most people significantly overestimate how much income they will actually need once they stop working. Why? Because the federal tax code treats retirees on a completely different set of rules than it treats workers. And almost no one walks you through how big that gap really is until you are already standing in it. So let me show you. While you are earning a paycheck, every single dollar shows up as fully taxable income. You also hand over FICA taxes on top of your federal income tax, and you do not get any deductions tied to your age. But the moment you cross 65, the rulebook quietly rewrites itself. Retirees stop paying FICA altogether. Their standard deduction gets bigger. They pick up an additional senior deduction. Their long-term capital gains can land in a 0% bracket. And their Social Security is never fully taxable. At the very most, only 85% of it can ever be hit with tax. Don't worry if every term I just listed sounds like a foreign language. That is exactly why most people walk into retirement with the wrong number in their head and end up working 5, 8, 10 years longer than they actually had to. So today, I'm going to walk you through what those tax differences really look like for workers versus retirees. What you are going to see is that if you were used to bringing home $100,000 while working, you do not actually need $100,000 of so-called income in retirement to keep the same lifestyle, purely because of how the tax rules shift and the size of that gap. It is going to surprise you. I'm your host, Marcus Hale, a retirement income strategist, and this is The Quiet Math, where we slow down the numbers behind retirement so you can make better decisions based on math and not on rumors. And as always, let's run the numbers. Let me frame this with a comparison that has been making the rounds in the retirement planning world. Two married couples. Both bring in exactly $100,000 of income. The first couple is 60 years old and still working. Their $100,000 comes entirely from W-2 wages. The second couple is 70 and retired. Their $100,000 is structured across Social Security, an IRA distribution, and a long-term capital gain. When you run those two scenarios through the federal code, the working couple ends up paying somewhere around $15,000 in tax. The retired couple pays somewhere around $300,000. That gap is roughly $15,000 a year. It is the headline number that has launched 1,000 thumbnails. And here is where I want to pull you in close. That headline is where most videos stop. It is where ours starts. Because that $15,000 gap hides 6 things almost no one walks you through. 6 cliffs and surprises that can either make the gap much bigger than it looks, or quietly erase it altogether. Get them right and you might retire years earlier than you think. Get them wrong and you can watch the entire tax win evaporate by your 74th birthday. Let's start with number 1. Because that $15,000 isn't really $15,000. It is bigger, much bigger. Quick question. If your boss walked into the office tomorrow and said, "I want to give you a raise," how would you react? You would not ask many questions. You would ask one. How much? So let me ask you that same question in reverse. If the only thing you wanted from a raise was an extra $15,000 of cash in your pocket each year, not pre-tax, not gross, but actually deposited into your checking account, how big would the raise on your offer letter need to be? The answer is uncomfortable. To net an extra $15,000 of take-home pay while you are still working, you need a raise of roughly $20,000 to $22,000 on the gross side. Why? Because every additional dollar of W-2 income gets hit by FICA at 7.65% before it even reaches the federal income tax stage. On top of that, most workers in this income range sit in a marginal federal bracket of 22%. Stack those 2 layers and roughly 30 cents of every new gross dollar disappears into withholding before you ever see it. Which means a $15,000 bump in actual take-home requires more than $20,000 in raise paperwork. Now flip the camera. The retired couple in our example didn't get a raise. They got a tax bill that shrank by $15,000. From a cash flow perspective, those 2 events are economically identical. But one is loud and the other is silent. One shows up on a pay stub with confetti and a manager handshake. The other shows up as the absence of money leaving your account. We are wired to celebrate one and overlook the other. So here is the reframe to hold on to. Retirement does not just lower your tax bill. It quietly hands you the equivalent of a $22,000 raise. You don't have to negotiate it. You don't have to outperform anyone to get it. You just have to live long enough to be eligible. And that is a big deal. It is also why people who run the math carefully tend to retire earlier than they expected. Once they realize their target wasn't really their target, the runway gets shorter than they thought. But here is the catch. That phantom raise has a self-destruct button built into it, and it only takes one withdrawal to press it. So what is the self-destruct button? Inside the planning world, it gets a name, the tax torpedo, and it lives in a corner of the tax code that almost no one explains in plain English. So I will. The IRS does not look at your Social Security check the way it looks at your wages. Wages are taxed dollar for dollar from the first dollar. Social Security is taxed conditionally, and the condition is hidden inside a calculation called provisional income. Think of provisional income as the IRS's secret thermostat. It looks at all your other income, IRA withdrawals, interest, dividends, and adds half of your Social Security benefit on top. Then it compares that combined number to two thresholds. If the thermostat stays cool, none of your Social Security is taxable. Crank it past the first threshold and up to 50% of your benefit becomes taxable. Crank it past the second and up to 85% gets pulled in. Now watch what happens. The retired couple in our scenario was sitting in the cool zone, where less than half of their Social Security was being taxed. Suppose next year they decide to pull an extra $10,000 from their IRA. Maybe a new roof, maybe a trip to Italy. The IRS does not just tax that $10,000. It also rec ranks the thermostat. And that rec rank can drag a much larger slice of their Social Security across the second threshold, pushing the taxable portion toward the 85% ceiling. Suddenly, the IRS is not just taxing the new $10,000 from the IRA. It is also taxing $15,000 or $20,000 more dollars of Social Security that used to be untaxed. The marginal effective rate on that one $10,000 withdrawal can land between 27 and 40%. In some structures, every additional dollar pulled from the IRA ends up costing roughly $1.85 of taxable income. That is the torpedo, and here is why almost no one notices it. Tax software shows you a single number at the bottom of the page. Total tax owed. It does not show you the marginal cost of the last dollar you withdrew. So retirees pull from their IRA, see the bill, shrug, and move on, never realizing that the same withdrawal sequenced differently would have left thousands of dollars more in their account. Torpedo or not, you actually have control over your withdrawals. Until you don't. Which brings us to a number on the calendar that changes everything. Age 73. So what makes 73 the cliff? Up until that age, the retired couple in our example has a privilege most workers never had. They get to choose how much income they show the IRS each year. They can throttle their IRA withdrawals up or down. They can decide whether to harvest a capital gain or wait. They can keep their provisional income just below the line that makes their Social Security fully taxable. That control is what makes a microscopic effective tax rate possible in the first place. It is not a feature of being retired. It is a feature of having dials they can turn. At 73, the IRS takes the dials away. The official name is Required Minimum Distribution, or RMD. Picture it like a faucet the government turns on for you, and you do not get to shut it off. Under the Secure Act 2.0, the IRS now requires you to begin withdrawing from your traditional IRA and most other tax-deferred retirement accounts, starting at age 73 for most current pre-retirees. The amount is not optional. It is calculated using a chart called the Uniform Lifetime Table, basically a list that says, at your age, divide your account balance by this number, and that is your minimum withdrawal for the year. At 73, that number is roughly 26.5. Now run the math. A couple with $1.2 million in a traditional IRA at age 73 is required to pull approximately $45,000 in their first RMD year. That is not a recommendation. That is a federal requirement, backed up by a stiff penalty if you skip it. Stack that on top of $40,000 of Social Security and a few $1,000s of dividends, and their reported income vaults from $100,000 to roughly $130,000 overnight. The dominoes start falling. The 0% capital gains bracket vanishes, because their taxable income is now too high to qualify. The Social Security taxation jumps to the full 85% ceiling. They might brush against the IRMAA threshold for Medicare premiums. We will get there in a few minutes. Their effective tax rate, the same rate that used to be a rounding error, can climb to 9, 10, even 12%. Same lifestyle, same spending, Same accounts. The only thing that changed is the calendar. So the beautiful tax scenario you see in most retirement videos? It is real, but it is not permanent. And if you don't plan for the day the IRS turns the faucet on, you can spend a decade enjoying low-tax retirement and then watch the tax bill quietly triple in a single year. And if you think 73 is the worst reset, wait until you see what happens the day a spouse passes away, because that one is uglier. This next one is the conversation almost no financial channel wants to have on camera. So we are going to have it carefully, and we are going to have it with the math, because the math is what protects the people who are listening. Here is the question I want you to sit with. What happens to your tax bill the year after your spouse dies? When two spouses are alive, they file their taxes jointly. That filing status is the engine behind almost every favorable number we have looked at so far. The standard deduction for a couple over 65, including the senior bonuses, can land in the neighborhood of $35,000. The federal tax brackets are wide. The thresholds for Social Security taxation are higher. The thresholds for the 0% capital gains bracket are higher. Married filing jointly is, in many ways, the most generous filing status the federal tax code offers. So what happens when one half of that joint return is gone? The day a spouse passes away, the surviving spouse can still file jointly for the full year of death. The following year, the survivor moves into single filer status. And almost everything contracts at once. The standard deduction for a single filer over 65 is roughly half of what the couple had. The brackets compress. A dollar that used to sit in the 12% bracket can now sit in 22 or higher. The Social Security taxation thresholds drop. The 0% capital gains threshold drops. Now run a real number. Suppose the couple from our example loses one spouse. The survivor still has roughly $80,000 of income. A slightly reduced Social Security benefit, the full IRA distribution, the same brokerage account. Under joint filing, that household paid almost nothing in federal tax. Under single filer rules, with the contracted deduction and compressed brackets, the survivor can easily owe $4,000 to $6,000 on a similar income. That is a 15 to 20 times jump in federal tax. On a household that just lost income, it is not a planning mistake. It is the design of the code, and it can get worse. IRMAA, which we will unpack in a moment, has its own single filer thresholds that are dramatically lower than the joint thresholds. So the survivor often gets hit twice. Higher federal tax and higher Medicare premiums in the same year, often during the most emotionally fragile chapter of their life. Here is why this matters now while both spouses are still here. There are real moves that can soften this transition. Roth conversions while filing jointly can shift money out of accounts that will trigger this trap later. Life insurance positioned correctly can give the survivor a tax-free bridge for a few critical years. A taxable brokerage account with a step-up in basis at death can change the math entirely. None of those tools work if the conversation never happens. So please, have it. Now I want to shift gears because we have spent a few minutes inside the harder chapters. Let's come up for air, because the next surprise actually works in your favor. There is a rule of thumb that has been on personal finance worksheets for 40 years. You may have seen it written as the 80% replacement rule. It says you need roughly 70 to 80% of your pre-retirement income to maintain your lifestyle in retirement. That number gets baked into every retirement calculator you have ever used. It gets quoted by financial planners in client meetings. It gets repeated in articles. And when it was written, it was probably about right. So why is it wrong now? Because of when it was written. The 80% rule was systematized in an era when traditional pensions were still common, when senior deductions were modest, when the 0% capital gains bracket did not exist in the form it does today, and when the enhanced senior deduction had not been added on top. Stack the modern updates and the math no longer holds. Let me show you what I mean. A worker earning $100,000 in W-2 wages takes home roughly $73,000 after federal tax and FICA, ignoring state tax. Of that $73,000, a disciplined saver is putting roughly 15% into a 401k, call it $11,000. That leaves about $62,000 actually being spent in a given year. Now ask the right question. How much gross income does that same household need in retirement to spend the same $62,000? Not $80,000, not $70,000. With no FICA, with the enhanced senior deduction, with a meaningful slice of Social Security tax-free? The answer lands somewhere between $63,000 and $67,000 of gross income. Roughly 63 to 67% of pre-retirement gross. Not 80. Now translate that into a savings target. And this is where it stings. Apply the 4% withdrawal rule. To produce $63,000 per year in retirement income, you need a portfolio of roughly $1.575 million. To produce $100,000 per year, you need $2.5 million. The difference between those two targets? Approximately $925,000. For a median household, that is close to a decade of saving. Read that again. A decade of your life, potentially spent at a job you don't love, chasing a number that was wrong before you started. If you have been told you need 80% of your working income to retire, you have been quoted a rule from a tax code that no longer exists. Now I want to be careful. This does not mean you should rip up your savings plan tonight. Healthcare costs, long-term care, inflation, sequence of returns risk, all of those still deserve a cushion. But the cushion goes on top of a realistic base, not on top of a target that was inflated to start with. And before you go shave $1 million off your savings target, there is one cliff we still need to walk you to, because it does not live inside the tax code at all. So what is the cliff that does not live in the tax code? It has an unfriendly name, IRMAA. It stands for Income-Related Monthly Adjustment Amount. And it is the reason a lot of retirees with otherwise modest tax bills suddenly see thousands of extra dollars leaving their accounts each year, without ever opening an envelope from the IRS. Here is what IRMAA actually does. It is a surcharge added to your Medicare Part B and Part D premiums. When your modified adjusted gross income, MAGI, basically your income after a few standard adjustments, crosses certain thresholds. For a married couple filing jointly in the most recent published bracket year, the first IRMAA tier kicks in at roughly $206,000 of MAGI. The second tier sits a bit above that. These thresholds adjust annually, so always check the current year before you plan. Here is what makes IRMAA different from a normal tax. IRMAA is a cliff, not a slope. Picture standing 1 inch from the edge of a building. Take one more step and you do not lose a few inches. You fall. Cross the IRMAA threshold by $1 and you do not pay a few extra cents. You pay a flat surcharge that can run roughly $2,400 per person per year on the first tier, about $4,800 combined for a couple. And it sticks. IRMAA is determined using a 2-year look-back on your tax return. So a one-time income spike, a Roth conversion, a large capital gain, an inherited IRA distribution can raise your Medicare premiums 2 years later for a full year. Now layer that on top of everything we have covered. The reason the retired couple in our example paid almost nothing in federal tax is not just that they were retired. It is that they were sitting comfortably underneath a series of invisible cliffs. The Social Security taxation cliff, the 0% capital gains cliff, the RMD threshold, the widow's filing status cliff, and IRMAA. Walk $1 over IRMAA in a year, you did a big Roth conversion. And the effective rate on that conversion can climb 30 to 50% once you add the surcharge to the federal bill. IRMAA does not show up as a tax. It shows up as a higher Medicare premium. But it does not care what you call it. It works exactly like a tax. The retirees who pay the lowest effective rates over a 25-year retirement are not the ones who avoid taxes. They are the ones who manage the cliffs. They sequence withdrawals around them. They time Roth conversions around them. They harvest losses to stay below them. So where does that leave you? It leaves you with a different way of seeing the headline. The $100,000 working couple and the $100,000 retired couple are not living in two tax codes. They are standing on a battlefield with 6 pieces of terrain. A phantom raise that quietly hands you $22,000. A tax torpedo that can flip a routine withdrawal into a 40% marginal hit. An RMD expiration date that resets the math at 73. A widow's trap that can multiply taxes overnight. A retirement target that may be $1 million too high. And an IRMAA cliff that punishes $1 extra of income. Manage them well and you can keep an extra $100,000 to $300,000 across a 25-year retirement. Manage them poorly and you can watch the headline gap evaporate. If you want to see exactly which order to pull from your accounts to stay below all 6 of these cliffs, the video I recorded just before this one walks through that distribution sequence step by step. You can click here to watch it next.